Dosto, this is Deepak, and with me is legendary Sanjeev Gupta CPA. And today we are going to talk to you guys about taxation in real estate. It's such a huge topic, and that's why we're bringing to you guys a special webinar that's happening next month. So if you have not really registered for it yet, please head over to sanjeevcpa.com and register for this webinar. It's online, it's free, so there's no cost to it. And in this webinar, we only do it once a year. It's 2 hours long. And Sanjeev will share so many different strategies, how you can leverage real estate to reduce your taxes. And I've been attending this webinar for almost, 12, 13 years now. And every time I walk out with something new, I guess part of that is because rules keep changing. And part of that is, you attend a webinar, but you don't really grasp everything, right? So it takes time. You've got to listen to it over and over and over again. And then so if you can just kind of walk out with one tip out of that webinar, and it can save you $10, $20, $30,000 on your taxes, I think that's well worth the money, right? In this case, there is no money. And talking about money, we do have a live seminar coming up in August, so you can definitely sign up for that. And if you join the webinar, we'll give you a special discount code for joining that live seminar, so you can come meet with Sanjeev Ji in person and ask your questions there. And then we also will have a wealth summit towards the end of the year, where you guys can all come and learn about how to build your wealth, how to save your money, grow your money, and protect your money. So that's what all that is. So that's what's happening this year. Now, today I want to talk to Sanjeev Ji about all bunch of questions that I got related to real estate from all bunch of people here. So if you have a question, you can definitely reach out to me via WhatsApp, or you can send me a message on Facebook, and I'll try to get those questions answered for you. So Sanjeev Ji, I have a lot of questions. By the way, so tax deadline is October 15th.
For October 16th for California residents.
For California residents only. So once again, just as a reminder, if you have not filed the taxes, you still have time. So please go ahead and file the taxes. If you owe any taxes, good idea to file them sooner than filing them later. Yes. So that way you don't get penalized for late penalties.
A lot of people have confusion in this. Again, we want to make things clear for a lot of for the people who are watching us. So if you owe taxes, and you owe taxes because of underpayment of estimated taxes for last 3 quarters of last year. Remember, there is quarterly payments. Each quarter is one payment based on estimated income. So it's April 15, first quarterly payment, second quarterly payment is June 15, third quarterly payment is September 15, and fourth quarterly payment is January 15 of the next year. Now, what happened with the extension deadline? They've extended the fourth installment of payment, January 15 to October. But they have not extended the payment for the last 3 quarters of last year, which is 2022, which I just said. So if you owe taxes because of underpayment of those taxes,
in first 3 quarters of last year.
First 3 quarters, then you have to file the return as soon as possible. Otherwise, think about it. If you file in August, September, you're paying additional tax and additional penalty interest for each month. Each month can go up to 1.5 to 2% of the tax due from January 15, from last quarter of last year, 3 quarters. So it can be 10%, can come to 15% of your tax due. So don't make IRS richer. Try to avoid those things. And plan your things. And if you owe taxes, please file your return on time.
All right. So let's get started with our real estate related questions. So that will kind of give you an idea of what you can expect at the webinar. So first one, this one is a very interesting one, Sanjeev Ji. First question is, am I going to get audited?
Depends. If you're claiming the losses from the real estate against your ordinary income and you don't qualify as a real estate professional, and you use that losses to offset your other income, W2 income, other income, definitely there are very heavy chances. IRS is very clear on this aspect, that when they see any losses from anything coming from real estate, and they know you're not a real estate professional, A, because you are working on W2 full-time job, B, you're not managing real estate on regular basis, C, you might have investment in other states. So how can you manage real estate in other states? So definitely it's a big red flag for losses coming from real estate setting off your other income. That the chances of getting audited is very high.
Yeah. And the reason why I asked this question, Sanjeev Ji, is so a lot of time people go to a tax professional to get their taxes done. But personally speaking, I come to Sanjeev Ji to learn what I should not do. There are things that you should do, and there are things that you definitely should not do. So I think when you join the webinar, when you come meet with Sanjeev ji in person at live seminars, or you do consultation appointment, I think it's extremely important for us to know what not to do so we don't trigger unnecessary headaches.
So it's very important because, like, for example, I want to give an example of short-term rental, which is becoming very important nowadays. So with everybody wants to do short-term
And it's
rental.
lucrative as well.
Lucrative as well, Airbnb and everything. But the problem with that short-term rental, there are rules and guidelines. People don't follow those rules and guidelines. They
And they
say,
get in
"Oh,
trouble."
short-term rental is all losses. Can use that losses to set up your income." That's not going to work because short-term rentals you have to qualify. There are certain standards to be met. So this is the one way where most CPAs, more tax professionals, they try to play around, but that's not right.
All right, so here's a great example. Another question. Can we finish a garage apartment to use a short-term rental on property that has a long-term rental?
Yes, you can definitely do that. You can use a garage for, of course, garage is separate. If it's separate from your main
Residence.
residence or your main part of your house, and you can definitely use that garage as a rental. You can use the garage for doing any business. You can do it as a garage for any kind of giving to somebody who needs that garage for storing some equipment, some goods. Of course, that can be possible.
Yeah, and that's actually a great strategy, right? Because a lot of us can have that extra garage.
Provided you don't have many things to store in the garage.
Yeah.
Like, otherwise, garage is full of all those junk.
Yeah, I think that's another whole webinar. We put the stuff in garage because we think we're going to need it one day.
But we don't need
We
that.
don't need it. As a matter of fact, I think a long time ago I was talking to one friend of mine. He says, I have a rule that if I don't need something for 6 months, then I don't need it at all. I just throw it away.
Yeah.
So
But we have a habit of putting everything in a garage, and then that garage keeps building up.
yeah, I told the guy, I'm like, look, in our country, the rule is 6 generations. So if 6 generations haven't used it, that's when we destroy it. All right. So garage is definitely a wonderful strategy. Here's another one, Sanjeev ji. So a lot of time people buy a short-term rental and they use the short-term rental tax benefit by using bonus depreciation, cost segregation and all that. And they take the benefit in year 1. Is it okay to convert that into long-term rental or perhaps even passive rental because, maybe they actively manage it year 1 and then going forward they don't manage it anymore?
So, first of all, we have to understand certain rules regarding short-term rentals. Like I just said, there are certain rules to be followed. First is, if you are having a short-term, what is a short-term rental? Short-term rental is any rental given to a customer who cannot stay more than 7 days in a year. Okay?
On average.
On an average. So he cannot be more than 7 days. So that is short-term rental. Anything more than 7 days becomes a long-term rental. So that's one rule. Second rule is 100 hours requirement. 100 hours of active involvement in that, managing that Airbnb stuff or a short-term rental. So I don't know. A lot of times people come and say, I go to the short-term rental once in a while, or just whenever the customer goes out, I have some lady clean up the apartment and put all this dry clean everything, and then put new things and everything. If you are managing that, you're putting more than 100 hours, yes, then you qualify for that short-term rental. Of course, your other rules are you have to have your money should be at risk. There should be involvement of the money, right? And so if you qualify for those short-term rental, and you can do cost segregation. Why you do cost segregation? Because you want faster depreciation, and with the Tax Cuts and Jobs Act, they have provided bonus depreciation for improvements inside the rental properties, investment properties. You can depreciate them faster. Like in cost segregation, we analyze different components of construction improvements like plumbing, drywall, all those different kind of electrical work. And they try to, the experts, the engineering tax experts, they try to give those cost segregation study, and you can do depreciation faster. But remember, one more thing here is, if you do depreciation faster, you have to recapture the depreciation when you sell that property. So of course, it depends when you want to sell it, but you pay a tax of 25%. So that also needs to be considered. Now, once you have a short-term rental and you want to convert to long-term rental, you have to find out what you've done during that period of short term. Did you use those losses against your current income? If then you cannot convert it to long term rental. If you not use that losses, is a passive loss, carried forward losses. You're not as per the guidelines. You're not there, so you can carry forward that losses. So in that case, yes, you can convert to long term rental.
All right, so there you go. The both options are on the table there. Here's a very interesting one, Sanjeevji. I think this is really good for a lot of people to know. How do I know if I'm being assessed for an underpayment penalty?
So that's why I started with that one, saying how do you come to know? You will not come to know. The IRS will send you a notice with all this underestimated tax payment, underpayment or estimated taxes, penalty and interest. So the thumb rule is, look at your last year return, which is 2021. For doing 22, you have to look at last year, which is 21. Look at the tax liability for 21. Look at the income levels that you have for this year. Is it more or less the same, or maybe increased by 10%? Or look at some transaction that you must have done. For example, you might have changed jobs, you might have got the stock options, you might have got the SPPs, RSUs, you were lucky your company got merged, or you sold properties, you have a lot of long-term capital gains. So if you have those income, definitely you're underpaying taxes, because that income is, you're not paid any taxes. So there will be, like I said, 4 installment: April 15, June 15, September 15, and January 15. So definitely you have to make those tax returns, make those payment on time with the tax returns. So that way you can avoid the penalties. But if not, it will keep climbing till the date of filing the return. So to find out how to calculate the how much underpayment you have done, just like I said, just spread your income over 4 quarters. Look at your last year tax liability. This year tax payment should be at least equal to 110% of the last year tax liability, plus any increase you have to pay 25% on that one in 4 installment. If you have done that, then yes. But if you've not done it, then it's subject to all these penalties.
All right, couple of interesting questions. These ones are really, really nice. So this is a realtor, and he's asking, look, I want to use my 1-year-old as a model for my business, and I want to pay him $500 per year as a model, and then I want to use that money to put in his Roth account. Can I do that?
Yes. So see, a few things we have to become when we look at hiring the kids. There have to be some certain sense when you hire a kid, right? If you are like 1-year-old, you can't even walk. He or she cannot even walk, or cannot even talk. So even making that person as a model is subject to risk, because how can that person be a model when you can't even talk or cannot even walk? So that's not possible. So what is the age that you can make your kid as a model? Maybe age 10 plus. They have to have some kind of education, some kind of primary education, something they can write, they can read, they can learn,
They can do.
they can communicate, they can talk. That way, yes. But if you're just using a small 1-year-old, you're just trying to manipulate this. It's very clear he's trying to manipulate and get it done. So the answer
So,
is
Mr.
no.
Realtor, don't do that.
Don't do that. Instead of that, you can do 529 plans for the kid. You can put money into 529 plans. That way, yes, you can do it.
All right, here's another one. This is also coming from a realtor. He is using another accountant, and he's saying, my accountant wants me to keep a time log and pay my kids a reasonable hourly salary. I want to give them a stipend of $6,000 so they can contribute to an IRA.
Right.
Similar question. Can I put them on board of directors seat? Ooh, that's a board of directors.
No, again,
one.
board of directors is a different meaning, total, because again, who are people who sit on the board of directors? The people with experience, the management, they have knowledge, they have qualifications. So you cannot just put anybody on board of directors.
So that one is definitely no. But I guess his real question is, hey, how can I pay my kids $6,000? My kids are 8, 12, and 16.
Yes, so you can pay some remuneration based on the hours they are spending. So the reasonable expectation, 12 to 16 years old, is like 12,000 to 18,000, and then it goes up, depends upon what kind of work they're doing and how much work they're doing.
Yeah, and should he be giving them 1099 or should he be giving them a W-2?
Mostly, if you are a sole proprietor, it's always good to hire kids as a W-2, because you don't have to pay Social Security and Medicare as long as the children age is under 17. if you have a S corporation, you want to run payroll, then you have to pay Social Security and Medicare. So it depends upon the nature of entity that you have. Based on that, you can look into it.
All right. So that's a good one, actually. I think a lot of people, one time, maybe during the Wealth Summit, we'll do a topic on that because I think there's a lot of opportunities there that people are not using. Okay. Okay. What other options do an high income earner making 300K to reduce tax liability? So STR is one, short-term rental is one. He's asking, are there other options that I can use to reduce my taxable income?
Well, depends upon the, if you're talking generally, there are a lot of studies like 401k maximization, HSA plans, business setting up businesses, real estate, if you're managing real estate as an active participation and managing it on a regular basis. So yes, you can use, so when it comes to real estate, if you manage it properly, if you put like 750 hours for management, not only you can take the losses, but you can also, if there's income from the real estate, you can use the qualified business income deduction, QBI deduction, which can take out 20% of that income, also not subject to taxes. So that's also a valid important point. Not only the depreciation, but you have to look at the qualified business income deduction too.
Yeah, and I mean, he put 300K in his question, but we have people who do 500K, people
Yes.
out there making $1 million, people out there making $2 million. So strategy is a little bit different for each person.
Yes, strategies are different, but see, the thing is, if you are married, one person working a job or second person is not working, then the second person can become a real estate professional. Or together you're working as a job in a job which you're busy, but on the weekends you're free. So one of you can pass the real estate exam, and once you pass the real estate exam, you hang your license with your mortgage, with the real estate mortgage brokerage companies, and try to manage your own. Instead of just selling to others, you can do your own management. It's about your own management rather than working for others. So people think about it. They say, oh, why I'm not in business of selling or buying and real estate for others. It's not about selling, buying real estate for others. You can buy real estate for yourself and manage them and get all the tax deductions yourself.
And that's what exactly this webinar is about. So we're going to be focusing a lot of those elements, things that you can do with real estate to leverage them to reduce your taxable income. Now, Sanjeevji, I have almost 70 questions, but I know you have a lot of appointments. So I'm going to end this video here today. But please do join us in the webinar. Sanjeevji will be there and he will answer a lot of those questions live for you guys. And in the meanwhile, if you have questions, WhatsApp me. Reach out to me via Facebook. If you have not registered for the webinar, head over to sanjeevcpa.com and register now. Once again, thank you so much for watching us, guys, and I'll look forward to seeing you on this wonderful webinar.
Thank you.